Hi, everyone. Welcome to the Family Office Podcast, where we bring you stories and strategies and solutions that matter most to private investors and family offices and business owners. I'm your host today, Andrés Ospina, and in today's episode, we're packed with some great insights that you don't want to miss. Our guest today is Carlson, founder and CEO of SRA 831B Admin, a true innovator in the world of risk management and alternative insurance solutions. Van has been on over 80 podcasts, built an Inc. 5000 company, and has more than 25 years of experience helping entrepreneurs and advisors navigate economic storms while building wealth and protecting what matters most. So we're going to deep dive today into why traditional insurance is failing many businesses, how the right risk strategies can create new opportunities, and what investors, advisors, and business owners need to know now with so much uncertainty in the world. So, Van, welcome to the show. We're excited to have you here.
Yeah, I'm excited to have our conversation and appreciate the intro.
For sure, no, 100%. I know we spoke a little bit about your career. You did how many years in the Coast Guard?
I did 4 years. I was a smart one. I got in and out. I got the GI Bill and finished up my school after that. So it was a good 4 years. I needed that and prepared me for the rest of my life, actually. So.
And reading up on your bio, I saw that your career kind of pivoted during the Great Recession, right? Leading you to build SRA 831B Admin. Can you share a little bit of like those aha moments that drove you to create a better risk solution for business owners?
Yeah, you bet. I was a pretty successful property and casualty agent. I retained my hat of working with business owners. As I grew my agency, I was able to hire a lot of things out, hiring employees and all that kind of stuff. But I definitely kept with the business owners. I love that aspect of the business, was working with business owners, entrepreneurs, people that are willing to take a risk every day to get up and try to turn a business into a profitable entity. And unfortunately, a lot of them just knew about the accelerated depreciation. So, I was talking about builders, subcontractors, really hardworking people, but they knew to buy more stuff. That was their big play, was just keep buying more stuff. And of course, they took the accelerated depreciation, but then they financed it, and all they did was bet next year was, every year, if they had a good year, they were just betting next year was going to be better. And that was a form of insanity. And so then I was exposed to a couple folks that had these plans that we're going to be talking about, the 831B plans specifically, and they took advantage of those markets. And because they were able to put away taxable dollars that were on a pre-tax basis and handle their risk much more effectively than the business owners that just didn't. And honestly, this is what big companies have been doing for a long, long time. I was aware of the code, didn't find it that exciting. And then here comes 08, 09. And then I realized, man, there's got to be a smarter way to manage not just your risk, but your financial risk that you take as a business owner every day. And sometimes you don't recognize that because we're entrepreneurs. We charge the mountain. We don't think negative thoughts when it comes to risk management. But unfortunately, you can get caught in the wrong situation and, find yourself, covenants of loans started to mean things. And unfortunately, I saw a lot of my clients at the time forced into auctions, bankruptcies. That's when it became pretty glaring to me. There had to be a smarter and better way to run a business. And so that's literally how the company came about.
So how did you kind of step in and start to help these companies?
It's getting back to that, the one trick pony stuff where, you talk about the CPAs. Most of us start out with our friends, our high school buddies, our college buddies that got CPAs, and we hire them to become our CPAs, and we start a business, and it grows. And as it grows, there's certain things that the CPAs will recommend. One of them, unfortunately, the first one is always going to buy more equipment, and eventually, as you grow more success, it's buy the building, and then offer employee benefits, and then that's really about it. I mean, there's a couple little other things they can do in there, but most CPAs, and I'm talking general practitioner CPAs, not your Deloitte's, your KPMG folks, and all those guys. They're advanced tax planners, but for the most part, your small to middle market business owners aren't aren't big enough yet to get to that point. Everybody's trying to achieve to that point, right? Where, hey, Deloitte's my CPA firm. You got to be pretty big to be with those boys. And, most of my clients aren't. They don't know about the 831B. So the 831B is this. It's a risk management tool. It was introduced in 1986, Tax Reform Act. So it's been around for almost 40 years. Unfortunately, a lot of business owners are just now starting to hear about this. It was introduced because very similar to what we're having in the marketplace today with traditional insurance. Traditional insurance today, obviously, if you're in business, you've taken substantial rate increases and you've got a lot more exclusions than you had 5 years ago. A lot of reasons for that. We don't need to go into that so much in detail, but insurance companies do what insurance companies got to do. No different than the banks were doing back in 08 and 09, right? They got to protect themselves at the end of the day, and that's what they're doing. And that being said, though, the burden is being put more back on the business owner, especially when you look at exclusions, and that's really self-insuring risk. Back in 1986, what was happening in '86 was the farmers were finding themselves self-insuring crop insurance. They also had some litigious. We were becoming more litigious in the '80s. Lawsuits were spiking. General liability premiums increased by almost 300% over a 2-year period, and you were scared to put a claim in because you took the risk of being non-renewed and really unable to find insurance. Very eerily similar to what's going on today, and so that's really where the ability to self-insure risk, and here's what I call it. I call it an unfunded liability, right? I have liabilities on my books. How do I fund those? Do I fund those with paying a premium and getting an insurance policy for my building, for example? Then there's things I'm just going to retain on my books. How do I want to fund those? And what I try to explain to the business owners is it's pretty simple. Do you want to use after-tax money or pre-tax money? And if you want to use after-tax money, just keep doing what you're doing and hope nothing ever happens. And you don't have unexpected expenses and all these other things. And we can kind of get specifically into risk, of the kind of risks we're talking about. I could just simply point out COVID. The reason why the government had to step in with all the government programs was that business interruption wasn't going to be covered under traditional insurance. So the government had to step in. Now, one of the things that's been, due to our rapid growth is having this simple conversation. If you were dependent on the PPP programs, the ERC programs, and all the other government programs that came out, what are you doing different today? And can you expect the government next time to step in on your behalf? I would argue no. And maybe we shouldn't have to begin with, because I think we're still paying. I don't know if everything's been shown yet. What we did during COVID, it's as much money as we threw out in the economy, right? There's cause and effects on everything that happens in the world, right? And maybe, hopefully, we've got all the effects due to COVID. I don't know yet. Time will tell, I guess. But my whole point is don't be relying on the government next time. Build a way, if you're having a good year, taking a little bit off the top, which is basically your tax liability, and still expensing it at the operating company level, and then dumping it into an 831B plan. And here's what the 831B plan says: as long as we're the administrator, so we admin these plans. We're the largest administrator in the country, actually, under 831B. That 831B has to look and feel like an insurance company. We, as your admin, would make sure we do that. No different than your 401k administrators making sure that you're adhering to the 401k legislation, right? Because those dollars stay tax deferred. Under the 831B, the premium you put into it every year also stays tax deferred, which is a pretty big advantage to the taxpayer and the business owner, right? So now you're expensing it at the operating company level, but now you're funding these risks on pre-tax dollars versus after-tax dollars, which ultimately just makes you a much stronger company long term. And you can see where the big companies adopted this pretty quickly. It became very expensive, blah blah blah. But after 08, 09, it became much more favorable to small to middle market business owners to be able to afford to be able to do these types of programs from a fee structure standpoint. And that's one thing that we pride ourselves on, is our fee structure is probably we're the lowest cost provider on these admin plans in the country, and we have the biggest pools, and we have all the other things that we've been able to do over the last, really since 08. And so that's really it in a nutshell, Andre, is the ability to use pre-tax dollars, still expense it at your operating company level. No different than if you took advantage of the 172, right? I mean, I'm all about buying equipment when you need equipment or when you need office supply, or, whatever. But buying it just for the sake of avoiding paying taxes is just craziness, right? Now you can still do this. You can still expense it at your operating company level, but now you're picking it up in the 831B plan, and you're able to manage your risk much more effectively and efficiently. One of the things we're seeing in traditional insurance right now is co-insurance clauses are going up everywhere, especially in Florida, states where you're coastal states where if you got wind damages due to a hurricane, you just don't have a $500 or $1,000 deductible anymore, right? You got a $300. I know some homes down in Naples, for example, had several $100,000 deductibles on their co-insurance clauses because obviously the value of the properties were significant. But those are unfunded liabilities in a business. And what we're seeing all over the country is more and more business owners are taking on bigger first dollar risk, which means they got to pay out their dollar before the insurance carrier comes in, covers it. They're getting big. I mean, I'm seeing $250,000, $500,000 deductibles now. And, that's a huge unfunded liability on their books that, given the time, if they do our program, they're able to build up those reserves, which again, the insurance company, right? Reserves, surpluses, and all those things, just no different than any other insurance company. They're able to handle that risk much more effectively using pre-tax dollars. And the reason why the pre-tax is so important is you just have more dollars to work with, right? So.
And we talked a little bit about the structure there, but very curious before we touch up on the structure a little more, and you touched up on why today it's definitely more important than even probably when you began because those deductibles are going up. But like, what does that look like in real life? Like, do you have any stories or results that kind of like surprised you, and things that
yeah. So, one of the things one of the things that's been interesting is definitely deductible reimbursements and the co-insurances and also dispute resolutions. Dispute resolution is a coverage that we provide to our clients for you're being sued and your general liability is not responding, and now you're coming out of pocket, and you can submit a claim to your 831B plan and help reimburse these legal bills that you're incurring because now you're being sued either between partners. I mean, I can go on. I mean, that's a pretty big one, right? But the other ones that are kind of unique are the supply chain risks. These are risks that you can't buy insurance for traditionally, right? You just retain them on your books. So supply chain risk, we saw a big spike after COVID. That was a big coverage that got hit. Third-party business administration liability is huge today, and what I mean by third party is you used to have hard paper files, or you at least used to have your own terabyte sitting in your own office or your own server, right? And that was retained on your property. Well, today, everything's up in the cloud, so they get compromised, and it's happened a lot over the last several years, and it doesn't get nearly as published as like. When Target has a breach, or I think a couple days ago, I think Alaska and Hawaiian Airlines had a big cyber breach. So, but these small to middle market business owners have breaches all the time, and it is so detrimental to their company. A lot of them, either they have a really small limit on their policies for cyber, or they may do a standalone policy, but their limitations are so much in those policies that you are cash flowing a lot out of your own pocket when you have a cyber breach. And so, going back to 86, and what I just described, supply chain risk, brand protection. Brand protection is huge today. And in cyber, that wasn't even a thing in 1986, right? It was 40 years ago. Nobody even thought about that stuff. It was we were just starting to go into the age of information and, the global economies and everything else. And now when you look back at it, it's like, my gosh, the amount of risk business owners have taken on over the last 40 years substantially has increased. That is self-funding for, because traditional insurance companies are not in a big hurry to increase their appetite for risk. If anything, they're having a contraction right now of risk, right? So it just in the traditional insurances. And so those are, I would just tell you that, brand protection is huge today. It takes years to build a reputable brand, but seconds to destroy, unfortunately, whether it's true or not, right? Whether, whatever, right? I mean, we all know the situations. We all can recall certain situations where we've read or heard about where, CEOs caught doing something he wasn't supposed to or whatever, but the brand damage is huge today. And those are unfunded liabilities. And I call it a double negative going on. So your expenses are going up, but you're more than likely your income's contracting because people are not not either coming to your company, into your business, or they're not buying your product anymore, or whatever's going on there, right? That's a bad day, and that's really when business owners, are I can tell you this: the longer I've done this, the best compliment I get as a risk manager, because that's in essence what we do. They just sleep easier at night knowing they've done our program, and that's a best compliment any risk manager can get, quite honestly. So those are things that I think, on a high note, I can go into specific details. A lot of our medical doctors, they find themselves with brand damage all the time, unfortunately.
That's big for us as well. I mean, we have many doctors and surgeons, dentists on our platform. So I'd love for you to elaborate on that.
Yeah. So today, with HIPAA violations, those are problematic. Audits, dealing with between Medicaid and Medicare. Those are hugely expensive to physicians, the medical community. They just are. We've been involved with those. I'm amazed how in depth and how much they have to go through, and the expense that they incur due to these things. And that's just a great example of just being able to take a little bit of dollars away and build these things up. And I hope they never happen, right? One way I would have your listeners think of this is like an HSA, right? Health savings account, right? As individuals, I can take on a bigger role and responsibility for my health care if I choose to do an HSA. Why? Because I'm going to have more out of pocket, and now the reward for doing that is I'm able to expense whatever I contribute to my HSA for that year off my taxes, right? Well, think of this as the same thing for a business, though. That's what you're able to do. Now, the business owner, here's the thing about the business owner, you could do up to $2.85 million. That wasn't the case several years ago. You can only do $1.2 million. And it started out in 1986 at 1.2. And then due to the PATH Act, they actually increased it to $1 million and then put a CPI rider on it. With consumer price indexing, so every year it's going up a little bit. Like this last year, I think it went up 50,000. So that's why it's 2.85 million this year. And the reason, Andre, I think, I should mention too, Congress is a big proponent of this program. They think it's a great way for business owners to stay in business, and ultimately that's what they want. We need the small business owners, the middle market size business owners, to stay open. They are the backbone of our economy at the end of the day. And so, but I should also mention that it's been abused as well. I mean, that's just the way that goes in our world. We, as Americans, we always, we're innovators for sure.
Yeah. Risk takers. We're
risk takers. Yeah, all of it. And back in the day, the reason why it became really popular with estate tax attorneys was playing it as an estate tax play, not so much as the ability to manage risk, but it was mostly done for estate tax play. And so that's where the IRS brought the attention of the IRS. And, if you're doing things for alternative reasons, you're eventually going to get caught. And that's showing itself. Now, when I mentioned the increase in what you can contribute every year, they also did away with the estate tax planning from an ownership standpoint. Who can own these things going forward? And it really has to be with the operating company. If the operating company owners we mimic the same owners of the 831B plan. Because keep in mind, this is a C Corp. So one of the things we get around with the 401k thing, the difference between a 401k administrator and an 831B administrator, we operate in the same ways, but the taxes are a little bit different because it is a C Corp. It is an insurance company. There are shareholders. You're able to declare a dividend down the road, or if you sell your business down the road, you can simply shut it down and pay long-term capital gains on the premiums. The premiums that are sitting in this thing do stay tax deferred during the whole time that this company's active. The only thing it is paying taxes on every year, though, is realized investment gain. So, for example, if I got a client paying $200,000, it goes into a money market account at 4%. They're going to pay taxes on that 4%, at the corporate rate, which is currently 21%. But it is taxed every year on the realized investment gain. That's the difference between that and a 401k. But the big thing down the road is it's treated as dividends or capital gains versus ordinary income. Or 401k, obviously, you're just kicking the can down the road, and who knows what the tax brackets look like down the road. And that's true for capital gains and dividends too, for that matter. But Those are all the differences there. But I do think that's I wanted to hit a little bit on the high note there, or I should say low note, that the IRS does not like these things. I think there has been abuse in the code. I will tell you this, SRA has been through a 6,700 promoter audit, which all that means is if you are promoting a tax code, which is what we are, you get the attention of the IRS, and they do a 6,700 promoter audit. We started our audit back in August of 22, and it shut down June of 24 with no changes. And so, for better or worse, it was I think it's something. What do they call that? We survived the battle. I don't know if we won the war, but we certainly survived the battle. So, and that's just part of the game you got to play in today's world, right? I mean, if you're going to do these types of things, but we have. Now, I should also mention too, real quick, this is not a risk-free adventure. One of the aspects that business owners need to understand is there'll be some pooled risk, which means you have the potential to pay claims that are unaffiliated to you. But you have to have that element in your insurance company in order to call yourself an insurance company, right? And what we're getting back to is the law of large numbers. How are you spreading risk out and all those types of things? And I think we've done a really good job with that to the point where, I think it's very clear that business owners are in a pooled situation. And that's something I want all business owners to really understand when they come to work, become a client of ours. But I think it's a manageable risk. And at the same time, you got to have risk inside your insurance company or your non-insurance company, right? So.
Yeah. I mean, you really answered my question kind of right before I asked it, which was, what should these business owners and investors know about being on the right side of compliance in order to really maximize their benefits safely?
Yeah. The distribution is a big one. We stay in our lane. Just like a 401k administrator, we're making sure that those dollars stay tax deferred. We don't manage the money. We expect to hand that over to their financial planner and their financial advisor. We like to work with those guys. There is an investment agreement the clients sign with us, but they are managing the 831B plans, reserves, and surpluses. And money makes money, as we all know. So we don't have a problem with those being invested properly. What we don't like is illiquid type of investments, especially in the first couple years. We want those surpluses to build, and then over time, maybe go into some more illiquid type investments. But then you and your financial advisor have to have a conversation whether or not is it a capital gains investment. Well, I don't know if I want that inside of a C corp then, right? So these are nuances that we help the financial planners understand a little bit about this vehicle and the advantages it brings to their business owners. And we hope it brings value to the financial planner, but we also, obviously, the business owner's got to be the one to win. And I think we do that through our fee structures, our compliance, and the ability to manage risk in a much more favorable way to business owners that, we hope to God, it's like the HSA plan, right? If I don't use the HSA plan, I eventually turn that into a retirement vehicle down the road. Fair enough? Yeah. Well, hopefully this 831B plan becomes same thing, right? For business owners, that they're able to use this as a retirement vehicle down the road. Why? Because they're not having their own claims. And the pools aren't being hit that hard. There's a limitation how much you're going to be paying in those pools anyway to really understand that part of it. But just know if you start to have your own claims, it's, you're going to bear the most of that, right? As a business owner out of your own 831B plan. But if you don't, and you're able to build those reserves up over the next 10 years or whatever, it becomes a substantial amount of your asset portfolio to you as a business owner. And I think that's another big attraction to business owners today. There's the 401ks and all those types of things. That's great. But, if you're a high net worth earner, 401k, for what you can contribute there, it's impactful, but it's not lifestyle maintaining kind of thing. You know what I'm saying? So yeah. I think the 831B can be that part of that. And here's the other thing too, I would tell business owners, it's not a silver bullet by no means. There's some education process, there's some due diligence you got to do. There's some level of understanding of risk management. I think business owners today probably understand that better than most. If they survived through 2008 and they survived COVID, they start to realize that I take a lot of risks to do what I do every day. And I think it's also a level where you're at in your business, where you've achieved at certain levels, where you start to back off risk a little bit, and you start to, how do I mitigate that? How do I protect what I've created, right? And that's at a whole nother level too, right? Where you hope you're in business long enough to where you have that mentality. In the beginning, man, everything's throttle down, right? I mean, you're growing, and you put every dollar back in your company, and you're doing everything you can to grow to this thing, and you get to that level, and then after a while, you're like, hey, man, I'm done growing this thing. How do I protect what I've got, and how do I protect my future? I think 831B plays a huge part of that.
Wow, no, that's super powerful insight, and yeah, I mean, I think with risk comes reward, right? So at the end of the day, that's the way that it has to be played, like you said, in today's world. Now, I mean, pretty much to wrap up, like final question here, let's talk a little bit about the future, right? Like what's the next big frontier in risk management now that business owners aren't really thinking about yet, but should be, right?
Yeah, no,
especially since you've seen this through so many market cycles.
Yeah,
and administrations.
Yeah, here's what I'd say, Andre, is it's not getting better anytime soon. In fact, it's going to get worse, I'm afraid. The LA fires are just starting to get priced in right now with the losses. It will be the one-time largest loss in the history of our country, which is saying a mouthful when you consider what hurricanes have done over the years. But that was fire. I mean, that was a basic reason why people had insurance back in the day. Why insurance companies even started was protect fires in cities, right? The Boston fires, right? I mean, that's why Hartford and all these other companies started was, how do we protect? And here's the thing about insurance. Insurance creates commerce, right? If I can go out and get a financing, the bank's going to require me to have insurance, and that creates that cycle, right? Where without good insurance, without the ability to obtain insurance, I can't create commerce. And so to me, it's a huge concern, in our economy, quite honestly. It could stifle our economy. And I don't know if there's people like the government just can't backstop everything, right? They backstopped flood insurance. They backstopped crop insurance. They backstopped now terrorism after 9/11. You have terrorism, and it's backed by the federal government now. At some point, the government can't just keep backstopping all these risks that we're dealing with today. And I think the burden is going to fall more and more to you as a business owner. And I know it's not sexy, and I know it's looked upon as negative, but I think if you're astute enough to recognize risks you're taking and manage that risk the best you can, help mitigate that risk. And again, it's not a silver bullet, it's not a complete solution to the problems. But to be able to take some of your tax liability and put it into a vehicle that you control, and you're able to use those dollars when that might be the only dollars you can even get to because your lines of credit, your bank's shutting down, whatever. Not to be too dramatic here, but I've been doing this long enough. That's the difference between living and dying with your business, is those abilities to get to those dollars. And I think that's, like every business owner out there, you owe it to not only yourself, but you owe it to the employees you're help supporting their livelihood with, the future of your family, and the brand and the reputation and the business you've built. You owe it to yourself to look at all the tools that are available to you to mitigate your risk. And this is just one of them. And at the right time, again, it's a hell of a tool. I hope to God clients never have to need it, because I can tell you this: if they do, it's not a good. Anytime you need insurance, it's not a good day, right? Not I can't think of any insurance situation where I might have a great day. I get to use my insurance today, right? But even with our stuff, it's even more so, unfortunately. And a lot of hard conversations I've had in the past, and they, like I said, they've been very thankful that they've had at least a solution or a part of the solution to be able to use these dollars now that they would have just gave to Uncle Sam, and Uncle Sam does what Uncle Sam does with them. But meanwhile, what's happening in my company? What's happening in my business? And so, again, Andre, I would recommend any business owner that's hearing this or haven't heard about these in the past, do your due diligence, dive hard into it, and understand it. And maybe you're not at the right time to put away dollars on a tax deferred basis. Maybe you're still trying to grow your business and everything else. But know that they're down the road. As your success grows, you're going to be looking for tools like this. And I hope you think of SRA first.
Awesome, Ben. That's hyper powerful information. I think you just ended off there with kind of like next steps, people doing their due diligence, but someone in looking into it and looking into SRA as a solution. But just really quick, if someone listening really wants to like weather the storm, get ahead of future risks, like what's one actionable step they can take this week, and where can they find you?
Honestly, we own 831b.com. I would recommend they start there. Micro captive is another place. Those are those small to middle market business owners that have their own insurance company. They're known as micro captives, excuse me. And our 831b.com, that's the tax code. And we have the 831b.com. It's an educational website. There's some resources there. There's some case studies they can request, specific to their industry, and how it worked and how it applied to them. And dive into it. I think that's again, you owe it to the risk you take. Respect the risk that we've all taken to do what we've done and go start a business. And learn all the tools you can to make sure the business stays alive during the good times and bad times. We've all seen companies thrive during the bad times. And that's what really drove me back in 2008 was, man, how many small business owners, I remember hearing this all the time. Man, if I only had the cash, right? 2008, 2009, 2011, if people had cash, they could have bought stuff. And I saw that. I saw business owners buying 10 cents on the dollar for raw materials. I saw real estate going for nothing compared to what it was in the past. And everybody was just wishing they had cash. And that's what drove me to do this. And I think, again, I hope we never have to go through those experiences. But if we do, you're going to weather it a hell of a lot better than your neighbor will, because you prepared on utilizing tax deferred dollars versus just accepting your fate. And I think that's what you owe to your business, and the work and the risk you took up to this point.
Yeah, that's really well said. I think once again, going into this economy and like you said, the added risks where now government insurance is backing up other things that weren't needed to be backed up before, deductibles going up drastically. Things like the LA fires, and the fact that there's just more business owners today than there was 20, 30 years ago. More people taking on risks, a riskier world. I think this is really important and valuable information to mitigating risk, which is the goal of every entrepreneur and investor, right? It should be the main goal, because there's a lot of risk out there. So really appreciate you being on our podcast and bringing this type of flavor. And I really hope that our listeners go check you out, go do their due diligence, and look at ways to support and help and help their businesses survive into the future. So Van, thank you so much for being with us today.
Hey, thank you. I appreciate the opportunity to talk to you.
All right. Thank you to our listeners. That is all for today.